Greetings and a warm welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor at wealthmanagement.com's RPA channel and CEO at Trow, TPSU, and 401k TV. I review all of this week's stories and select the most important and interesting ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story. As expected, Trump issued an executive order directing the Department of Labor to reevaluate guidance on alts and crypto in DC plans within 6 months, clarifying their position on fiduciary responsibilities while working with other agencies to harmonize their positions. While pension funds regularly use private market investments, which the Georgetown Center for Retirement Initiatives claims can boost returns by 15 to 22 basis points, unlike small to mid-sized plans, these pension managers are more sophisticated with greater resources to evaluate less transparent investments, which includes CITs. Meanwhile, the Trump family has launched their own cryptocurrency, adding $620 million to Trump's personal net worth. Next story. What does ChatGPT say about private equity investment? It says that it appears to be a safer, diversified investment than it really is because the managers control its own valuation, leading to overuse, undermining asset allocation. Because PE firms will self-report quarterly, they can smooth out returns and are not marked to market, providing wide latitude by general partners to determine fair value. And crypto is the epitome of volatility, which can rattle many investors, especially those close to retirement, all of which has ERISA litigators licking their chops if alts and crypto become popular in DC plans. Next story, the Texas State Securities Board issued guidance on the use of data aggregators, clearing the way for advisors with clients in Texas to use firms like Pantera in held-away accounts like DC plans. The board guidance includes evaluation of the nature and scope of the service, review of agreements and policies, cybersecurity practices, proper record keeping, and client disclosures about risk. Though some major record keepers have banned the use of Pantera, claiming data risks, some believe the motivation is to be able to manage those assets themselves. Other record keepers will not indemnify accounts that use these services, but firms like Pantera have their own insurance policies. Meanwhile, Pantera has added former EPSA director Lisa Gomez as a strategic advisor. The demand by DC participants to allow their advisors to manage their accounts is growing and may better engage decision makers at the plan, likely to have an advisor to provide more resources to the DC plan. Next story. According to the brilliant folks at 401k Marketing, cold calling and mass email campaigns are dead. It's getting harder to get people to answer an unknown caller due to spam, with uninvited calls considered to be disruptive. Same with emails that use errors and 5500 forms highlighting a plan's failures. Instead, to build trust, 401k Marketing recommends educational content, short videos, plan sponsor guides, webinars, and to focus on what's working, like plan design. They highlight the importance of LinkedIn, which most plan sponsors start with, asking, do you have a picture? What is the message? Have you posted anything? What's your education and experience? Marketing isn't a quick hit. It's about consistency, clarity, and relevance to build a brand. And 3 months isn't a timeline, it's a test. Great advice by 401k Marketing. Finally, the biggest paradox in the DC market is that while the relationship between the plan sponsor and their RPA is the most important, much less time is spent on due diligence than with investments and record keepers. Read my recent wealthmanagement.com/RPA column on how this paradox is hurting plans and participants, especially by advisors who recommend do as I say, not as I do. Last but not least, this week's LinkedIn poll asked, given the choice, what type of retirement plan would employees prefer? 42% said they would want a DB plan, followed by 38% in a traditional DC plan, and 18% for DC plans with retirement income, and just 5% on their own with an advisor. So those were the most important and interesting stories from the past week. I listed a few others I thought were worth reading, covering small businesses rarely claim retirement plan tax credits, Voya's earnings surge helped by One America acquisition, guide for DC plans investing in private markets, HSA's withdrawals increase as healthcare costs grow, and lessons from Top Gun for an advisor. Please let me know if I missed anything or if you'd like to comment. Otherwise, I look forward to speaking to you next week on 401k Real Talk.